Welcome back to the deep dive. Today we are wrestling with a question that really it defines the modern speculative technology sector.
Mhm.
Is the company we're looking at a visionary, a builder of tomorrow's digital infrastructure? Or is it, just a sophisticated hyper-leveraged bet on the price of a single, highly volatile commodity?
We are diving deep into MRI Holdings, ticker MARA, and this company is right in the middle of a strategic whirlwind. They're attempting this massive pivot from being a pure play Bitcoin miner
Right.
into something much broader, this digital energy and infrastructure provider.
And that pivot requires staggering amounts of capital.
Oh, absolutely. And that hunger for investment, that's what creates the core conflict in this whole story.
Exactly. So our mission today is to cut through all that noise and analyze MRA using comprehensive sources available up to the market close on November 14, 2025.
Yep.
At that time, the share price was sitting at 11.99
And our analysis shows this stock is an absolute battleground. I mean, on
Mhm.
one hand, you have Wall Street analysts who are overwhelmingly bullish,
Yeah, we saw price targets suggesting, what, a 92% upside?
a potential 92% upside, yes. But then on the other hand, the company itself is just plagued by this massive, accelerating operational cash burn.
And a severe structural weakness that we found, which makes the entire investment a kind of zero-sum race against time.
Yeah, and the market itself seems to get it. We found that it's exhibiting this deep skepticism, sort of looking past the headline-grabbing record profit announcements.
Right, the gap illusion we'll get into.
Exactly. And it's pricing in the operational reality. I mean, this is easily one of the most complex, high-risk, and, potentially high-reward profiles we have ever analyzed.
I agree, mainly because its future success is just entirely contingent on variables outside of management's direct control.
The price of Bitcoin, essentially.
Now, the price of Bitcoin. So to make sure we extract every crucial nugget from the source material, we've broken down our findings into 7 rigorous chapters. We'll start by understanding the ambitious business model, the scale they've achieved. Then we are going to spend significant time dissecting the management structure, particularly one massive, what I would call an unforgivable red flag,
Oh, I know what you're talking about.
before exposing the potentially misleading nature of the company's stated financial health. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding.
All right.
Let's start with this aggressive business model pivot.
Mm.
Historically, MRA's core identity was pretty straightforward. They were a pure Bitcoin miner.
Right. They deploy specialized computing equipment, we call them ASICs,
Yeah, the ASIC.
to solve complex mathematical problems, validate transactions on the Bitcoin network. It's the whole proof of work mechanism. And for doing that, they earn new BTC.
End of story. Highly commodity dependent.
Exactly. And that traditional model is inherently capital intensive, and it's completely exposed to the underlying commodity price. So management is trying to change that narrative entirely.
They're repositioning.
They're repositioning MARA not as a miner, but as a digital energy and infrastructure company. And look, this isn't just fluffy rebranding. They are actively developing 2 entirely new, albeit, nascent revenue streams.
Okay, so let's detail these. The first one is high-performance compute, or HPC, and it's specifically targeting the AI sector. They made a pretty significant move here with the $168 million acquisition of Exaion. That was a former subsidiary of the French state-owned utility EDF.
Which is a big deal.
It's a very big deal. And the goal here is ambitious. They want to leverage their existing expertise in running these massive, secure, energy-efficient data centers, skills they developed mining Bitcoin, to provide low-carbon compute services for high-demand AI workloads.
So it's a sophisticated move. It attempts to create a high-margin, relatively stable revenue stream that's independent of Bitcoin's price volatility.
Right.
And the second stream is, well, it's potentially even more transformative, energy and grid services.
This is the really interesting part. MRA is moving from being a passive, often criticized consumer of energy to an owner of power generation.
That's the key to the entire infrastructure narrative. They entered into a partnership with MPLX to build up to 1.5 gigawatts of natural gas-fired power generation facilities.
And on paper, the strategy is brilliant. They mine Bitcoin when grid demand is low and energy is cheap, so they're essentially utilizing energy that might otherwise be curtailed or wasted.
But then, and this is the critical part, they can sell that power back to the grid during peak demand or scarcity events.
So it transforms their biggest operational liability, that massive energy consumption, into a monetizable, flexible asset.
Exactly. And to appreciate the scale of this pivot, you have to look at their current operational leverage. I mean, this is no small startup. As of Q3 2025, their energized hash rate stood at 59.4 EHs.
EHs, that's exahashes per second.
Exahashes per second. And to put that into perspective for you, an exahash is a quintillion hashes per second. This 59.4 EHs, it represents a massive computational footprint. It places them as one of the largest players globally.
And that gives them economies of scale. Few competitors can match.
For sure.
And the power of their war chest is also, it's unmatched. Their Bitcoin treasury is the largest in the entire industry. 52,850 BTC held as of September 30, 2025.
Which is nearly double what it was just a year prior.
It's incredible growth.
And at recent prices, that BTC treasury is valued at over $5 billion. This holding isn't just a measure of success, it is their primary moat. It gives them this unparalleled strategic flexibility for M&A, for infrastructure build-out.
Or for just covering operational shortfalls. If they need cash fast, they can sell a tiny fraction of that treasury.
Yeah.
So if we look at the broader industry, the 2024 Bitcoin halving event, which cut the reward miners get for validating a block in half, that effectively doubled the cost of production overnight.
And that caused intense consolidation. It strongly favored massive, well-capitalized players like MRA who can just continue to invest in the latest, most efficient hardware.
And the institutional view seems to reinforce this bullish backdrop.
It does. JP Morgan analysts, for example, have identified the global cost of production for Bitcoin, which is currently estimated around $94,000, as a sort of natural long-term floor.
Okay, explain that. How is it a floor?
Well, if the price drops below that point, less efficient miners become unprofitable, so they stop selling their BTC to cover their costs. The overall supply of newly mined BTC shrinks, and the price finds support. It's a supply-side floor.
Got it. And that's coupled with JP Morgan's highly bullish long-term target of, $170,000 for BTC?
Yeah, which they derive from a volatility-adjusted comparison to the market cap of gold. If that target ever materializes, MRA's existing treasury and infrastructure investments are, dramatically validated.
Okay, but the regulatory environment presents a classic double-edged sword here.
It really does. On one hand, federal support is high. A 2025 White House executive order explicitly supported the responsible growth of digital assets and protected the ability to participate in mining.
And that high-level backing is a critical shield against any existential regulatory threats.
For sure. But local opposition remains relentless.
Yes.
MRA faces constant lawsuits and significant opposition in communities over noise pollution from their massive cooling fans and the heavy strain they put on local power grids.
Right, diverting cheap energy away from residential users. So it confirms that while the feds are supportive, the cost of just securing local operating permits remains a persistent, expensive headwind.
So let's just briefly frame the competition. MRA is focused on the HODL strategy holding BTC and this aggressive diversification into AI and energy ownership.
Okay, and you contrast that with Riot Platforms, which is also large, but they're heavily focused on data center expansion for third-party hosting.
Right. And then you have CleanSpark, often viewed as the pure play, operationally focused miner that tends to sell the Bitcoin it mines to fund its continued expansion.
So MRA's stated competitive edge is achieving the industry's lowest cost of production through vertical integration, owning the energy supply, mining in real time, using excess capacity. That's the cornerstone of their whole bullish narrative.
It's the justification for their enormous capex. But, and this is where we find a critical gap between the narrative and the reality.
Good.
The data suggests this advantage has not yet materialized. Their reported energy cost per BTC in Q3 2025 was around $39,235. And other reputable industry trackers like CoinShares place their total electricity cost even higher at approximately $46,972 per Bitcoin.
And why is that figure so concerning?
Because that cost places MRA squarely in the middle of its peer group, according to the sources. They are not yet the lowest cost producer.
So the promise isn't reality yet.
Not yet. They have the assets, they have the scale. But the operational efficiency payoff, the primary justification for spending billions on infrastructure, it has yet to appear in the quarterly reports. This suggests execution risk is high as they enter this very expensive pivot phase. Chapter 2. Management evaluation.
With such a massive pivot underway, The leadership team is everything.
It is. And CEO Fred Thiel, he's overseen massive scaling since taking the helm in 2021. He's responsible for that 170% year-over-year surge in BTC holdings and the transformation into a global player.
And he's also demonstrated some prudence in financial crisis, right?
He has, like diversifying company cash across multiple banks and short-term U.S. Treasury bills after the 2023 banking crisis destabilized the sector. That was a smart move.
So a track record of effective crisis management and asset accumulation.
Yeah.
But the next point we have to discuss is the compensation structure.
Yeah.
For a value investor, this is arguably the single biggest governance red flag in the entire analysis.
It is a profound issue of misalignment. Let's just look at the data. For the fiscal year 2024, CEO Fred Thiel's total compensation was an astonishing $43.2 million.
$43.2 million.
And the total comp for all key executives combined was over $83.2 million.
So $43 million for the CEO of a company that, as we are about to detail, is not operationally profitable and is burning cash at an astronomical rate. I mean, doesn't every high-growth tech company reward its leaders? Why is Emory's high pay package particularly concerning here?
Well, it's not just the high number, it's the structure of it.
Yeah.
This compensation model suggests management is being rewarded for aggressive growth metrics, like increasing the hash rate or expanding market cap.
Metrics which are overwhelmingly funded by diluting the very shareholders they're supposed to serve.
Exactly.
Can you elaborate on how that links to dilution, just to be crystal clear?
Certainly. If the company needs to raise cash to fund CapEx to achieve higher hash rates, they issue new stock. The stock hits the market, the share count goes up, and the per-share value of your existing holdings decreases. That's dilution.
And the management team receives massive stock-based compensation, which is the bulk of that $43.2 million, for achieving these growth targets, even if the net result is a significant negative free cash flow.
So a value investor has to conclude that management's primary interest is rewarded by the size of the empire, regardless of the direct cost to the shareholders' ownership stake.
So when we look at their capital allocation strategy, we see this aggressive investment focus reflected everywhere. Massive capex on new ASICs.
Yeah, those specialized mining chips.
Building out infrastructure, and M&A, like that $168 million Exaion purchase.
Precisely. The focus is growth at all costs. But when we pivot to shareholder returns, the picture is, well, it's barren. MRA pays no dividend.
And while you might see reports of share buybacks in some summaries, our sources clarify that these are not actual share repurchase programs designed to return capital or reduce the share count.
So those aren't true buybacks.
No. They are merely repurchasing shares from employees to settle the tax obligations on their restricted stock units, their RSUs, that have vested. It's an accounting function, not a capital return policy.
So the company's primary method of capital raising is aggressively issuing stock, and its method of returning capital is definitively zero.
Which brings us to the crucial question of what kind of return MERA is generating on all this invested capital.
And it's highly complex. I mean, calculating a clean return on invested capital, an ROIC, is almost impossible because the capital base is constantly ballooning from new stock and debt issuance. You can't get a stable denominator.
So we need a reliable proxy. You mentioned free cash flow.
Free cash flow, FCF, is the brutal truth. It shows the cash generated after paying for operating expenses and CapEx. And since we know MERA's FCF is massively negative, the conclusion is inescapable. The company is currently a capital destroyer.
A capital destroyer.
It is following a high-risk venture model, spending vast amounts of shareholder capital today with the hope of generating explosive returns years down the line. But it is absolutely not a capital generator in the present. And that's a critical distinction for you to understand.
Chapter 3, Financial Health.
Okay.
If you are prepping for a meeting, this financial data section is the most dangerous because it is incredibly deceptive. You have to peel back the GAAP accounting layers.
Right. We have to first acknowledge the obvious volatility. MERA's 5-year revenue trend clearly illustrates the high beta profile of a commodity producer. We saw astronomical growth of nearly 4,000% in 2021.
Unbelievable.
Followed by a negative 25.79% crash during the 2022 crypto winter, and then a massive 228.81% rebound in 2023.
That kind of roller coaster ride confirms one thing.
Yeah.
This company's financials are entirely dictated by the Bitcoin spot price, not by stable, predictable operational excellence.
And that brings us to the most critical segment, what we're calling the DAP illusion, or the net income trap. This is what misleads most headline readers.
Okay, let's unpack this illusion fully. The headlines for Q3 2025, they were stunning. MIRA reported $252 million in revenue and a phenomenal $123 million in net income.
which suggests an incredibly healthy 48.7% net margin.
That sounds like a profitable technology stock.
But it is a complete mirage. When you go into the 10Q filing and look at the breakdown, you find that a whopping $234.2 million of that reported profit was a non-cash gain. It was derived from the mark-to-market valuation of digital assets.
So let's be clear. They didn't earn that cash by selling power or selling Bitcoin they mined.
No.
They earned it because the accounting standards required them to revalue the 52,850 BTC they already held on their balance sheet upwards when the price of Bitcoin went up that quarter.
Yeah.
It's pure paper gain. It's not operational income.
Exactly. And the market is sophisticated enough to see through this. This is why the stock fell 6% on the day of that record profit announcement. Institutional investors ignored the headline profit and focused on the underlying operational metrics, which showed a loss of 32 cents per share when you strip out that paper gain. The core business is still operating at a significant loss.
And that loss is tied directly to the core of the bear case, free cash flow generation. If the income statement is a fantasy, the cash flow statement provides the brutal self-funding truth.
And the FCF trend dramatically illustrates why we call this enterprise a capital furnace. The negative FCF accelerated rapidly from about negative $25 million in 2020 to negative $343 million in 2023, and then reaching a catastrophic negative $924.3 million in 2024.
Nearly $1 billion in negative cash flow in 1 year. And the 2025 update shows no letup.
No. For the first 9 months ended September 30, 2025, they reported negative $578 million in net cash used in operating activities.
The company's burning hundreds of millions of dollars quarter after quarter just to keep the lights on, acquire new hardware, and pursue this growth trajectory.
And this constant capital requirement is what necessitates the continuous shareholder dilution. That's the engine of dilution right there.
So let's talk about their financial stability. It relies on this barbell of debt and equity issuance. Their debt-to-equity ratio is now 69.5%, which is a dramatic increase from 0.2% just 5 years ago. We're talking $3.6 billion in total debt.
And that leverage adds severe risk. If Bitcoin prices suffer a collapse, that massive debt load becomes an existential threat because their ability to service it depends almost entirely on the market value of their underlying asset.
They do cite a relatively healthy current ratio of 1.88. That suggests they have, $1.88 of short-term assets for every dollar of short-term liability. But you flagged this as potentially deceptive.
Yeah.
Why should you be cautious about a ratio that looks statistically sound?
Because the health of that ratio is only as stable as the asset supporting it. MRI's current ratio is heavily dependent on their highly volatile BTC holdings being classified as short-term assets.
Right.
In any other industry, short-term assets are usually cash or accounts receivable, which are stable. Here, the asset is Bitcoin. If Bitcoin were to suffer a 50% crash, that 1.88 ratio, which today suggests they can comfortably cover their short-term bills, could be instantly halved.
Pushing them dangerously close to liquidity distress territory. The stability is illusory.
It's an illusion.
That leads us directly into the valuation trap. If you just look at the raw price-to-earnings ratio, NAA looks incredibly cheap, cited as low as 4.42, especially compared to rivals like Riot Platforms at over 38.
The PE ratio is not just useless for MRA, it is dangerously misleading. We cannot stress this enough.
Why?
Since the E, the earnings, is a non-cash accounting fiction derived from those mark-to-market paper gains on their BTC treasury, it tells you absolutely nothing about the underlying operational health or the actual cash flows of the business. Any true financial analysis must immediately discard PE as a metric here.
Okay, so PE is out. What about the gold standard of corporate finance valuation, the discounted cash flow or DCF model? Can we use that?
A traditional DCF model is both inappropriate and, well, practically impossible for MRA. The model relies on projecting future free cash flows into perpetuity.
And MRAs is massively negative.
Exactly. So you would have to arbitrarily assume some future crossover point, say 5 or 8 years out, where they suddenly become cash flow positive.
And if you change that assumption,
If you change that assumption by even 1 year, the resulting valuation changes wildly. And even worse, the entire valuation is a speculation on a speculation. The ultimate outcome of any DCF model hinges exclusively on your guess for the future price of Bitcoin.
so assuming BTC stays at its cost of production floor, say $90,000, that yields one valuation. But assuming JP Morgan's $170,000 target yields a valuation that is multiples higher.
Right. The stock's intrinsic value is tied purely to the speculative price of the commodity, not to the company's current ability to generate capital.
So the valuation is ultimately driven by sentiment and the commodity price, divorced from operational metrics. Like and subscribe to Stock Analytics AI.
For $4.99 month, get 500 plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
All right.
So now we cross into the territory where Wall Street optimism collides directly with trader reality. This is that battleground environment we talked about. Let's start with the overwhelming bull case from the analysts.
Okay. Based on research from, 10 to 14 different brokerage firms, the consensus rating is a powerful buy, or a strong buy. The average price target is $23, with some targets going as high as $29.
So with the price sitting at $11.99, analysts are suggesting a remarkable 92% upside. They are selling the narrative of scale, the AI pivot, and the inevitability of BTC appreciation.
But that consensus is powerful, and it contrasts starkly with market behavior.
It does. As we've noted, the market is ignoring the analyst targets and the headline profits. The clearest indicator was the price action following that Q3 earnings announcement. The stock fell 6%.
The market sold the underlying operational loss, not the accounting fiction being pushed.
Exactly. And this brings us to the scale of the bearish bet. We have to look at the short interest, which is massive. MARA has an enormous bearish bet against it, 25.25% short interest as a percentage of the float.
Wow. Over 1/4 of all tradable shares are currently sold short.
Yeah, and that is significantly higher than its peer group average of about 14.30%. That means a massive cohort of smart, well-funded investors are betting the company fails to generate sufficient cash flow, or at least that its price decreases due to dilution or falling BTC prices.
This level of short interest is a huge indicator of skepticism.
It is. However, it also introduces volatility. It creates the potential for a violent short squeeze.
Right.
If any unexpected positive news, like a sudden Bitcoin surge past $100,000 were to hit, these shorts would rush to cover, pushing the stock price up rapidly and artificially. So this high short interest transforms the stock into a volatile spring ready to unwind.
Okay, so from a technical analysis perspective, the picture is also unequivocally bearish, reflecting that deep skepticism.
Absolutely. The stock is trading 33% below its 50-day moving average, which sits around $17.92.
And it's trading 24% below its 200-day moving average, which is $15.85.
And in technical terms, when a stock trades that far below its key moving averages, it signals strong downward momentum and a lack of institutional support in the immediate term.
So we have a clear divergence. Wall Street analysts are extremely bullish on the future story, that $23 target.
But the price action and technical indicators are firmly in strong sell territory, reflecting the present operational reality and the massive short positioning. This confirms MRA's identity as a true battleground stock.
Chapter 5. Ownership structure.
So when we look at who owns MRA, we see this long list of sophisticated institutions. Over 700 of them hold shares, and the three largest are BlackRock, Vanguard, and State Street.
Which usually signals strong long-term institutional backing, right?
It looks that way on the surface, but we have to make a crucial distinction here, which is vital for you to understand. We call this the illusion of active ownership.
Okay.
BlackRock, Vanguard, and State Street are primarily the world's largest providers of passive index tracking ETFs. We know that one of the largest single holders is the iShares Core S&P Small Cap ETF.
So these huge investment houses aren't discretionary managers endorsing the stock after deep research. They're forced buyers.
Exactly. They are mandated to buy MRA simply because it is included in the underlying index that they track, like the S&P Small Cap 600. Their buying activity is passive. It is not an endorsement of management or the strategy or the fundamental valuation. They hold shares regardless of performance.
Which can mask the true sentiment of active investment managers.
Yeah.
Okay, so now let's look at the true smart money signal. The insiders.
Right. The executives and board members who have the clearest real-time picture of the capital burn and future prospects, they own 8.39% of the company.
And the signal from those insiders is crystal clear and, frankly, highly negative.
Consistent selling throughout 2025. SEC Form 4 filings show active, non-stop selling by key insiders, including CEO Fred Thiel and Director Douglas Mellinger all year long.
So let's just synthesize this ownership structure. The people who know the most, the insiders, are actively selling their shares into the market.
And those shares are being passively purchased, often by the people who know the least about the company's specific financials, the index funds.
That is the perfect summary. For any prospective long-term shareholders, this dynamic active selling from within to passive funds on the outside is a massive negative signal. It suggests that those closest to the information believe the stock is fully, if not overly, priced at current levels.
Chapter 6, Risk Assessment.
All right. To build a robust investment thesis, we have to frame Bowery's future using a comprehensive SWOT analysis, focusing both on the existential threats and the monumental upside.
Right, let's start with the foundation of the bull case, the strengths and opportunities.
Strengths are undeniable. You've got unmatched scale, hitting 59.4 EHs, and that immense 52,850 BTC treasury.
Yeah, which gives them that unparalleled financial flexibility to weather market downturns or execute large M&A deals.
And the opportunities are visionary and high stakes. The underlying assumption is that Bitcoin soars toward those institutional targets like $170,000,
Yeah.
which would validate the entire HODL strategy.
And the Exaion acquisition positions them to capture the high-margin, rapidly expanding AI and HPC demand. If their vertical integration with MPLX succeeds, it could, theoretically, finally deliver that coveted lowest cost of production advantage.
Insulating them from competitors.
Exactly.
Okay, now for the foundation of the bear case. The weaknesses and threats. We've detailed the internal weaknesses. Catastrophic, accelerating cash burn, structural dependence on continuous shareholder dilution just to fund basic operations.
Misleading jet financials that mask operational losses, and a massive debt load of $3.6 billion.
And we absolutely must reiterate the misaligned executive incentives. That $43.2 million pay package rewards dilution-funded growth over tangible per-share profitability.
Yes. The core internal weakness is that the business model, as it stands today, is not self-sustaining without external capital injection.
Okay, moving to external threats. The existential threat is always a Bitcoin price crash.
A new crypto winter would be devastating given the debt load.
Beyond that, you have global hash rate competition compressing margins as more players invest in the latest ASICs.
And energy price volatility directly hits their primary cost of goods sold, overriding any vertical integration advantage they might temporarily achieve.
We must also look at the macroeconomic headwinds because MRA is a classic reverse Buffett stock in this current environment.
That's interesting terminology. Can you explain what you mean by reverse Buffett?
Sure. Warren Buffett prefers businesses that are capital light and have strong pricing power, allowing them to thrive during inflation and high interest rates.
And MRA is the opposite.
It's the opposite. It is a price taker. They can't charge more for Bitcoin. High inflation is a direct negative, increasing the cost of equipment, energy, and labor, while simultaneously compressing their already slim operational margins.
And the current high interest rate environment must be toxic for a high leverage growth company.
Absolutely toxic. High rates dramatically increase the cost of servicing their $3.6 billion in debt. And crucially, high rates increase the discount rate used by investors to value Mary's expected future cash flows.
And since Mary's positive cash flows are highly speculative and years, if not decades, in the future, the higher the discount rate, the lower the present value of the stock. The company needs a dovish Fed and lower rates to justify its valuation.
Okay, now let's tie all this risk back to the operational model with what you call the biggest, newest external threat. The 2025 tariffs.
This is perhaps the single most acute external risk facing MRA, precisely because it amplifies their core structural weakness, that need for capital. In April 2025, the U.S. government imposed new tariffs ranging from 24% to 55% on the specialized ASICs imported from China and other Asian nations.
And these ASICs, just to remind everyone, these are the computers that actually do the mining. They are the core required equipment.
Exactly. And the nature of Bitcoin mining is what our sources call an ice cube business. You must constantly purchase the latest, most energy-efficient ASICs requiring massive, mandatory capex just to maintain your competitive position and avoid the rapid obsolescence of older hardware.
If you stop spending, your cost of production quickly rises and you become unprofitable.
Right. And now that mandatory capital expenditure has gone up by anywhere from 24% to 55%.
This creates a vicious cycle.
A vicious cycle that massively accelerates MRA's greatest structural weakness. Dilution. MRA funds its cash burn and its continuous capex by issuing new stock. Because the 2025 tariffs dramatically increase the cost of this mandatory capex, the company will be forced to print even more stock, accelerating that primary structural flaw, shareholder dilution, just to maintain its current competitive position against global miners who aren't subjected to these tariffs. The tariffs are a direct material headwind.
Chapter 7. Conclusion.
So our entire deep dive brings us back to that central conflict we started with. MRA Holdings is fundamentally a binary bet.
It's a high-stakes race against the clock. The entire investment thesis is a bet that the bull case, BTC appreciation toward $170,000, coupled with the successful capture of high-margin AI and energy demand.
That materializes before the cumulative effect of the bear case destroys the per-share value of the enterprise.
And the bear case is that toxic combination of catastrophic cash burn, the structural shareholder dilution machine, that massive debt load, and the powerful new geopolitical threat in the form of the 2025 tariffs.
We have to restate the valuation truth one last time. A traditional DCF is inappropriate, and that $11.99 share price is anchored purely to market sentiment and the speculative future spot price of Bitcoin, not to its negative cash flows.
The value is either near zero if BTC stagnates and the pivot fails,
or it is multiples of today's price if the bull case succeeds flawlessly. This is a speculator's stock.
So the final outlook is that MARA is the ultimate speculative battleground stock. It sits far below analyst targets, suggesting potential explosive upside, but it is characterized by terrible technical momentum, massive short interest, and insiders who are actively and consistently selling their shares.
An investment here is a high-risk trade. You're betting on massive macro trends and flawless management execution to overcome severe structural financial weaknesses, particularly that need to constantly dilute shareholders just to remain competitive.
Which leads us to a final provocative thought for you, the listener, to consider, especially given the financial profile of this company. If the business model fundamentally requires constant shareholder dilution to survive and grow its empire, can management truly be aligned with the goal of creating per-share value when they are rewarded so handsomely with a $43 million CEO compensation package for metrics based on growth, not cash flow or profitability?
That is the moral hazard at the heart of the MARA story.
Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.